In this lesson, we're going to take a look at one of the big robo-advisors out there, and that's called Wealthfront. So we'll go in there, do a screencast, and you can kind of get a peek around as far as what the site looks like and how it works. And I'll give you some opinions as we go along, and maybe Wealthfront or some of its competitors like Betterment might be right for you. We'll take a look. Okay, here we are at Wealthfront. Simply wealthfront.com there, and Wealthfront is a robo-advisor. They basically are in between that full-service financial advisor and you being kind of a do-it-yourself advisor. There's several other companies out there as well, like Betterment, that we'll take a look at. But first off, let's look at Wealthfront here. And we'll actually run through how they kind of do it and how they get started here. But first off, a couple things that they emphasize so you can kind of see what what their positioning is from a company. They talk about how investing. And one thing that they do is that really stands out for them is they've got on their team Burton Malkiel, I'm probably pronouncing that wrong, and Charles Ellis, who've written some real famous books out there, particularly A Random Walk Down Wall Street is a very famous book, one of the top sellers. If you go on Amazon right now and look at top sellers of business books, investing books, Random Walk Down Wall Street will be there as well as Winning the Loser's Game. So on their team that's helping to advise them on putting together these portfolios for people are these two leading folks. And certainly as far as their expertise and philosophies really tie into that, and they really heavily promote that. Now, how involved are they in the day-to-day operations on it? Who knows? I have no idea. Maybe they're just a consultant, maybe they're an advisor, maybe they're part owners, maybe they're really involved. Who knows? But they're trying to follow these kind of philosophies around it with these folks. So they really promote that. And these are good books. I'd recommend these books. I think they're pretty good books. So particularly Random Walk Down Wall Street is a very, very famous book. So they look at that from a philosophy standpoint. Next, they talk about costs. Well, what does this cost to do? And how they do is a little different than having a pricing chart. They got this kind of calculator here. And you can see on the bottom where it says account value, it currently says $100,000. One thing about both Wealthfront and Betterment, if you're not from the United States, it might be when you log in, let's see if it gives you in pounds or in your currency, or if you can even do it, because as we look further, there might be things that this may be limited to U.S. only, but something to take a look at. Because I'm based in the U.S., so that's what I'm seeing. So if your account value is $100,000, what you pay them every month is $18.75 as far as their fees. And they'll put together a portfolio, they'll manage it, they'll do these things we're going to look at in just a second, but you basically pay them $18 a month if you have a $100,000 portfolio. Now, the nice thing about some of these robo-investors, particularly Wealthfront, and Betterment too, but if you have a low amount you want to get started, and let's say your account value is $500, and they're going to ask you to continually invest in stuff, but you pay no fee at all. They actually have a way to get started without paying a big fee. Or if you have a small amount, like let's say, it's hard to slide this thing, but that's one criticism there, but you get the idea, is let's say my account is, I'm going to go on here, is $11,000, let's see, it just jumps up, $20,000. Well, I pay $2.25 a month on $20,000. And if you got a lot of money, you just keep sliding it over. If you've got $630,000, you pay $129 a month. So their whole thing is that they're going to put together a portfolio view of low-cost funds or low-cost investments so they can keep your overall fees down, is the idea behind it. So that's one thing why they put up front here is they're really trying to keep your fees down, and they're going to do all this investing for you, right? You don't have the time to do investing, they say, so you're going to, they're going to manage it for you, which is really nice. It's really good if you want to have kind of a portfolio that's kind of automated and doing it for you. Once again, they're in between that full-service advisor and doing it yourself. And different things they do some things like tax allocation, commission fees, diversified portfolio, all sorts of things that they set up there for you. If we look at, let's say, why Wealthfront, a couple of things on there. One thing I'd look at is, let's say, like our low fees. Once again, these things could change at any point in time. I'm just showing you, the current example on there. Also, I don't represent Wealthfront or any of these robo-advisors. I actually don't invest with them because I'm an expert in this, so I do it myself. But this is would be something, especially if you're a younger investor or less confident, maybe this might be a way to look at. And they talk about the cost here is first $10,000 is managed for free. That's pretty good. And then low 0.25 annual advisor fee. That's a typical index type fund thing versus, let's say, 1 or 2% or more on actively managed funds. They do look for an account minimum of $500, and you can actually invite your friends, basically be an affiliate marketer for them, and they'll give you a break on it. So FAQ and some things you can check out, and they give you an example of how fees add up over time, which is true. Fees add up over time. So they're very much trying to manage it for you, low fees, be tax efficient, and follow these methodologies as far as investing and passive investing, and let the indexes and things work for you. They'll talk about who we are, and they'll once again emphasize, their different experts that they have in there that they've brought on board, and and how they kind of do it. And also, under what we do is they'll share a little bit more information on there too, the different types of accounts they have, retirement, non-retirement. Once again, this is another indication, might be really U.S. only, 401k, Roth, that's our USA type things. And it talks about the benefits of diversification and how they do their diversification. I believe I saw somewhere that they have like 11 different funds that they use to give you diversification. So not like hundreds or thousands, they keep it pretty tight, and you can see some of the examples here. But we're going to actually sign up, well, sort of sign up. We're going to get started with it so you can kind of see how it works, and and see if this is for you. So we go back to the home page. You can get started with Invest with Wealthfront. I'm going to go a little ways without having to actually sign up, but you can kind of see how it works. First thing they're going to do, and what these other robo-advisors do, is try to get an idea of your risk tolerance and get an idea of what some of your goals are. And so they might ask you some questions around that. And Wealthfront does a nice job of asking some good goals. Now this is a little salesy too, because once you pick something like, I'd like to create a diversified portfolio, well, that makes sense. Like, great, at Wealthfront, we do that, yay. Well, wasn't that something? So let's say I'd like to save money on my taxes, sure. I like someone to completely manage my investments. Well, that's the main idea of having them. If you're doing it yourself, then you don't need Wealthfront. I'd like to match or beat the performance of the markets. Well, who wouldn't at least like to match, right? That's index investing. And, good news, they do that too at Wealthfront. Well, okay. But if somebody was really interested, let's say, on one particular thing, they could highlight that, and maybe it'd be all about, let's say, performance or something. But we'll pick all of them because they all sound pretty good. What is your current age? I'm going to put in here. There's a lot of folks that are younger actually use Wealthfront. They're probably about 2/3 to younger versus like millennials versus, let's say, boomers from an age range. So let's say somebody's getting started, and let's say they're 27. All right, maybe they're going to start low. Let's say 30, just a round number. So let's say we're going to get started with Wealthfront. You're 30. You could put in whatever number you are, so you don't have to sign up. And let's say I have $30,000 US in pre-tax income. So this is how much I'm making a year is $30,000, right? Let's bump that up. Let's say I'm now making 35. Let's say I'm making 35,000. Well, that's terrific. But you put in whatever number you're making. And what's following best describes your household: single income, no dependents, like no children, single income, at least one dependent, like a child, dual income, and all this kind of stuff. So I'll say it's dual income, no kids or dependents yet, just me and maybe the wife or your spouse. What is the total value of your cash and liquid investments? So what would you be bringing into Wealthfront is what they're kind of asking. It could be very small. It could be a large amount. Let's say I've got $30,000. I'll just leave this here. Let's say I've got $30,000. So I'm 35 years old, and I want to invest $30,000 with Wealthfront. I'm maybe transferring some stuff over and to get started. When deciding how you invest your money, what do you care about more? Maximizing gains, minimize losses, both equally. Somebody who's very risk averse would want to minimize losses. Typically they'll pick. If somebody was, let's say, I just want to maximize gain, I'm real risky, then I might pick that. So let's say we want to do both equally. We want to be kind of more of a moderate investor. We want to get some gains, but we don't want to get crushed in our losses. We don't want to be riding the wave all the time. So I click that. Global stock market is often volatile. If you lost 10% of its value during a month during market decline, what would you do? So your whole portfolio goes down 10% in a month. This is a gauge to see what people do. Some would be like, oh my God, I got to sell. This is like terrible. I'd sell all my investments or sell some. Some would keep all of it. Some would buy more. You just choose whatever you want to choose. If you're a moderate investor, we're going to use this person as a persona, as a moderate investor. They might say, well, we might keep it all. We're just going to buy and hold, and we're going to keep. We won't buy more, but we'll keep what we got. All right, so answering those questions, they're now going to look to create, quote, the optimal plan for you based on their philosophies and things. Remember, this is their philosophies, which could change at any time. They're doing this for you. Then you put in your email and you can get your plan, and they can start marketing to you and get you all set up, right? But I'm going to close this just to take a look at the plan, because they actually give you that, which is really nice and transparent. I like that. That's pretty cool. All right, so this is a taxable investment mix versus, let's say, a retirement investment mix. Maybe if you had like Roth IRAs and 401ks, those numbers would probably change, and they do. You see, for a retirement mix, they get a little higher in income type stuff because of how retirement things in the U.S. and their IRAs and 401ks, there's some benefits to that. But let's say this is taxable. This is outside my 401ks or taxable account. This is just money I've got to invest. All right, so my risk tolerance, they say, is an 8. I don't know what that means. That's on a scale of 1 to 2 or 10 or whatever. But I can lower my risk or increase my risk level, and we'll see what happens to my investments or my portfolio. We'll do that in a second. So based on the fact that I am 35 years old as this example, and I have $30,000 to invest, and I answer the questions to be kind of a moderate type person, I could always go back and change my answers by the way here. But I'm a moderate person. In fact, if we go over here, it talks about how they came about with this thing based on your targets and your things. But here's your diversified investment plan. So they basically got me 35% in U.S. stocks, 22% in stocks outside the United States, 17% in emerging markets. Got some dividend stocks, 8%. A little bit in natural resources. That's interesting. A sector right in natural resources like oil and gas, that type of stuff, timber possibly. And municipal bonds, and this is why another reason why I wonder if this is really U.S. based, because municipal bonds are bonds by cities, and there's a lot of tax advantages in the United States if you own municipal bonds inside the state where you live. There's going to be a whole course on municipal bonds, but if you're one of my students who are outside the United States, and I'm really blessed to have many students outside my United States, go to Wealthfront and just see what it does. If it asks you things like, what country you're from or whatever, it might. So it might not be for you. That's all I'm saying. Maybe this is strictly U.S. based. So with that, you can see, wow, that's pretty. I've got like 13% in bonds, and it's all in municipal bonds. The rest is in stocks. If you see this, natural resources, dividend, emerging market, foreign stocks, U.S., the rest is in stocks. And if you look at foreign and emerging market together, well, what is that, 22 and 17? That's 39%. That's pretty hefty, in outside the United States as far as what a lot of financial planners, a lot of people recommend. And that could change over time. Maybe their advisors and their team thinks U.S. stocks are overvalued, so they're looking for, these foreign stocks or emerging markets. At the time we're looking at this emerging markets, we're down, for example, so maybe they're trying to buy low. Okay, so that's my portfolio that they gave me. I could then sign up. I can change my answers and change my portfolio. I could change my risk tolerance here. So I could, go, let's say I want to lower my risk. Let's say it was originally 8.0. You see where it says I'm going to lower my risk tolerance. So I don't want to be as risky. See how my stock portion went down and my municipal bonds went way up? Because I'm trying to take out that stock, that volatility risk, and getting more into bonds, which will help minimize risk that way. But if we were back at our 8, or let's say we go higher to all the way up to 10, I guess is the maximum. So that's something real risky. You can see very little in bonds and all that. I bet if I change my answers, let's lower this back to the 8. And I bet if I change my answers, this is the whole thing here. I bet if I change my answers, then it would change too, but also it would change based on the original number I put in. Remember when I started here, invest with Wealthfront, and there was a part where it asked me my age and things like that. If I put I was 60 years old, it would probably give me less risk investments as well. So the idea behind all this, just showing you a little bit, once again, I don't work for Wealthfront, not recommending them or anything, I'm just showing you what they are. And the idea is that you could get this plan that basically they spit out for you based on these answers to your questions. And then they'll actually manage it, and they'll do some tax efficiency things where they're actually buying and selling types of stuff with tax loss harvesting. It's in the course talk about tax loss harvesting, where you're selling basically your losers, the things you've lost money on, and buying more winners, and that you can actually then use those taxes towards that. So there's some tax efficiency in there, which is good. They certainly talk about their low fees that we looked at before and how the fee structure works. That's working nonstop. You can set it and forget it. That's the whole idea. You just sign up, you set it, they do all the stuff for you, they buy and sell for you, and you can always check your account balance anytime, and the dividends are automatically reinvested for you, which is nice. You don't have to do anything. You basically set it and forget it. That's the idea of all these robo-investors, and that's the idea behind Wealthfront as well, too. So that's Wealthfront. If you're interested in them, check them out. There's a lot of other ones, too, like Betterment and others we'll take a look at, but that's Wealthfront, and might be it's a kind of a newer type thing where it's not a full financial planner where you go into the office and you sit with them and you have this whole discussion and big whole sorts of things about goals and stuff, but it's not completely do-it-yourself either. It really is in between, where it's like, I'll answer some questions and they'll spit out a portfolio for me. Though even look at the portfolio we did, for me even, who takes I take on a lot of risk and stuff, even I'm looking at that like, that seemed a little risky, but they're using their experts to make these recommendations, and who am I to say that they're not right? So Wealthfront might be a robo-investor for you to check out.